Hello, everybody. It is May 1st, and this is the Equi market call. You're tuning in to hear a recap of what took place in markets in April, as well as a little bit about what to expect in the month to come. As a reminder, we are Equi. We are one of the fastest growing invest tech platforms out there with a focus on non-correlated alternative investments. I have with me today my esteemed co-founder, Itay, our chief investment officer. I am Tori Reese, CEO and co-founder of Equi. And let's get into it, Itay. What you got for us?
Hey, Tori. So again, another month in the market, a few more banks failing, kind of the normal nowadays. But it's really not about the bank failures. It's about much bigger things when it comes to liquidity and some of the really big macro things like the dollar that we're going to discuss today. Because I think, what we're seeing in the banking system, for example, are just symptoms. And we want to find out what is the core issue that's causing these symptoms. And again, it goes into a lot of the things we've been discussing in prior market calls and have built over the past few years as a part of our kind of broader macro point of view.
That's right. Yeah, it makes sense to, the headlines tend to focus on these big events, but everything was set in motion quite a long time ago. Because I remember almost a year ago, you were talking about some of the structural issues that you felt might lead to some major bank failings down the road. And here we are, new weekend, and another bank put in receivership, First Republic. So where do you start with something like this?
Yeah, so let's cover some of the more recent market events, and then we can hop into some of the bigger macro stuff. Let me share my screen, and we can just hop right into it.
Perfect.
So we're going to start with this market update. This is May 1st, 2023. And if you haven't heard that word 7 million times already, I'm going to give it to you today. It is AI. And even though we've seen these headlines about bank failures and we've seen contraction in a lot of really economic outputs, leading economic indicators, etc., the market has recently been on tear. And what's been driving this tear is truly artificial intelligence, or this quote, revolution in productivity we've been hearing about. And I just wanted to quantify how much AI has actually influenced the market in 2023. First off, you can see the numbers of earning transcripts with a mention of AI or machine learning in one kind of way in the S&P 500 in April. So every day that goes by, we get hundreds of more transcripts talking about AI.
That's a dream chart. So what we're looking at is a chart that basically looks like between 0 and 5 mentions on average. And now we're getting up to 50. So we're looking at 10x growth. This is the type of slide you'd include in a fundraising deck.
Yeah. So it reminds me of, in the 2000s, it was kind of like you wanted a bigger valuation, you change your company to a .com. So maybe now it's .ai or some kind of machine learning, and boom, you get your 10x valuation.
Yeah, I had heard rumors that, it went from Facebook to Meta, but now they're going to call themselves the artificial intelligence company, right?
I don't know if that's true, but just to give you an idea of roughly the 8% return or so in 2023, how narrow it's really been, 53% of the S&P 500's performance could be attributed to AI, basically money going to AI within the stock market. When you're looking at total growth, S&P, Nasdaq, etc. And it's just 7 companies that have accounted for 90% of all the gains in the S&P 500 this year, which is truly astonishing, even in an historic perspective, thinking of 2000, 1999. This is the most narrow Nasdaq rally really in history that I can tell, going far back, which is truly mind-boggling. If you try to dig deeper, Microsoft and Apple, 2 companies alone, account for nearly 40% of the entire 2023 gains of the S&P 500. So the U.S. economy is almost entirely dependent on Apple and Microsoft. But if you add NVIDIA and Meta to it, it's 60%.
That's wild. I remember it wasn't that long ago when it was during the pandemic, you were talking about the concentration risk of the S&P 500. And here we go, when two stocks are driving the whole index.
Correct. And you're looking at the divergence in the markets. Why liquidity and concentration risks are a real issue, because the market tends to perform the best and stay in a quote bull market for a long period of time when the entire market participates, when it's very broad based, when it's driven by good liquidity. But when liquidity is not great and it's driven by just a few stocks, the risk is substantially higher, because all that it takes is for those few stocks to stop performing well, and then the whole market can potentially roll over. And here you're really seeing the innovation, quote, AI revolution stocks here in red, which is really the mega techs. Then we have the 5 other largest companies. Then we have the 11th to the 50th, and then it's kind of the whole stock market. So exclude, by the measure as the Russell 2000, which is actually negative for the year.
Yeah, I see that. So these top 2 lines on the chart, you see growth really just in those top big names, but then everything else is either just a little bit sideways or even down.
Which is a really interesting market dynamic in 2023 so far. So when you're looking at the advanced decline line, so in this case, we're looking at the breadth of the market. So how many stocks are advancing versus declining on a cumulative basis daily versus the price of the Nasdaq composite, because that's very influenced by just a few names, right? Because if Apple is 40% of the index or 30% of the index, a move in Apple is going to move the whole price of the index. But when you're measuring it by just the broad amount of stocks, so imagine if it was just purely equal weighted and each stock got one vote, more to speak, instead of market cap, it's essentially almost making new lows that are lower than the ultimate lows the Nasdaq made last year, which is just staggering. These type of narrow market rallies, historically speaking, have been unsustainable, which is why I'm bringing this up and why I'm digging so deeply into what is really the driver of these rallies and gains.
So why did the 2 line, why did we see this divergence starting in what is that? Is that early 2021? What sort of kicked off the divergence between the advance and decline?
It's more like late 2021. I think it's very, very liquidity sensitive and liquidity driven. So if you outlay the Fed balance sheet on it, if you look at type of, different type of liquidity measures, you'll see that that's much more liquidity sensitive. So as liquidity disappears in financial markets, it impacts the broader and the smaller companies first, and then the mega caps can kind of hold on much, much longer. But it's just interesting to see how the market is really performing. So, it is my opinion that if we want this rally to sustain, we need more drivers than just 7 companies. There's only a finite amount of what 7 companies can do.
Right, makes sense.
At the same time, the Nasdaq itself is not cheap. So we all know the price to earnings ratio, forward multiples. So that's not cheap on that measure too. It's around 25, which is almost as expensive as it was at the end of 2021. But one of the things people don't look at is the attractiveness of equity returns versus the risk-free rate measured by, let's say, US Treasuries. So when you're looking at this type of premia, the current earnings on the Nasdaq are actually just about the same as the yield on the 10-year Treasury. So the equity premium there in the Nasdaq is actually the smallest it's been for really since the global financial crisis. So the combination of very narrow breadth and very low equity premium, I think, is a concern for kind of long-term valuations. Obviously, it's not the type of thing you can trade on and say Nasdaq's going to be higher or lower 3 months from today. But typically, when you're looking at these type of indicators over the long run, they tend to predict equity returns fairly well.
So this would kind of run counter to some of the popular narrative right now around buy the dip, because you'd argue this actually isn't a dip.
I would argue this isn't a dip when it's led by 7 companies and basically really inflating these long-term valuations. So I would still think that the 2023 rally thus far doesn't have the type of indication of a new expansion. So a new expansion comes in with a lot of liquidity, usually easing Fed policy, equity premiums become more attractive. As you can see, they came out of 2009 in the recovery. The risk premium became a lot more attractive when equities early in 2009. So we just haven't seen that yet. So I'm not saying that can't develop, but I just think it's early. And so far, we're not seeing a lot of indications of this type of sustainable rally.
Sure.
At the same time, corporate earnings, which obviously impact a lot of this, which impact valuations and things of that nature. So earnings are still down year over year, and this has been the fourth consecutive quarter of negative earnings growth when you're looking at the broader S&P 500. So we are effectively in an earnings recession. But again, it came from a relatively high place post-pandemic where things were really booming. And what's curious about the earnings summary is that earnings have actually been better than expected. So the bar was very low this quarter, and the majority of equity markets of stocks, really of equities, outperformed the very low bar that they were set. But the bad news is that the companies that are beating are not outperforming in the way they used to when liquidity was very abundant, and the companies that are missing the low bars that they have are getting absolutely devastated. So investors quote tolerance for underperformance is very low so far in this earnings season. And one of the things that I think is a little bit troublesome when you're looking at the future earning guidance. So you can see, we've been in this 4 quarters of declining earnings, and now it is anticipated for earnings to reaccelerate. So for this earnings recession to end. But you could argue that forward guidance right now is far too optimistic given where macro condition and guidance are. So I do think there may be a lot of room for earnings revisions down the line, which could cause some more equity volatility in the balance of the year. So let's dig into some of these mega caps, right? Particularly Amazon. I think Amazon is a really interesting case study because unlike some of the AI companies, it is driven by real economic demand for stuff, right? The US consumer is very important. The US economy is very based on consumption. So it's interesting to look at the Amazon earnings and kind of analyze them. It was also the earning where they initially jumped 12%. They disappointed at some guidance. Stock went down 12%, very volatile. So, every VC would like to invest in this type of chart, right?
Yeah, I think that's safe to say, especially when the numbers that we're looking at are in the billions.
I think the time of VC for Amazon is long gone, but this is an example of just their AWS revenue, $83 billion over the last 12 months. And that AWS revenue alone is higher than the revenue of 460 companies in the S&P 500, which is just stunning.
Staggering.
And it represents about 40% annualized growth since they started in 2013. So say what you say about Amazon, but they really know how to grow these revenues. And the reason I bring this up is there's another way to look at the total revenue growth of Amazon, which is very different than what you're seeing in these very optimistic charts, which, again, I'm not discounting AWS revenue growth at all. That's an incredible accomplishment. But when you're looking at the broader total Amazon earnings adjusted for inflation, so this is an interesting way where you're looking at revenue growth minus CPI year over year, because I do think it's very important to look at CPI with Amazon because it is based on real prices of suppliers and demand, etc. Earnings collapsed 50% year over year. So you can see that between 2021 and 2023, real revenue growth is really at historic lows, which is around 0%. So if you account for that, the stock is actually trading at 115x earnings with no real revenue.
Wow. So if we have one chart that's just up and to the right, although it was flattening, this one actually has a fair amount of volatility, but then it just collapses here at the end. That's a huge change.
I mean, we all know what happened to Amazon post-COVID, right? There was this sudden massive explosion in demand and then overhiring and then kind of now restructuring. But at the same time, we have normalized now. And when you account for the increased cost of inflation, Amazon's not really making that much more money. So I do think that's something interesting to look at when we think of the US consumer.
Yeah, makes sense.
Okay, we covered earnings. Let's talk a little bit about the yield curves. We've talked about this multiple times as a sign of potentially an imminent recession. It is kind of a clever. You have yield, but agricultural yields.
Yeah, I see what you did here. A little farming reference never hurt.
Okay, so we covered the 210 multiple times. This time I want to bring in the 3-month treasury over the 10-year treasury. So very, very short term, 3-month bill over the 10-year. This level of inversion has always been associated with recession being imminent, i.e. 6 months, 8 months tops. So again, this level of inversion, market is expecting the Fed to cut rates, and then that curve inversion will come back in, which would be associated with the recession. So we went from the 210, giving us more of a 12 to 18 month time frame, 3-month to 10, more of the Fed's favored recession indicator, getting very, very close to recession trigger. Now, I want to talk about what I think is a much more interesting inversion in the yield curve than the 3-month or 210 or everything we've been talking about. It's really the 1 month by 3 month. And that's been something that I've never seen before. And I've been following these yield curves for a very long time. And you're seeing a situation where the 1 month US bill is trading substantially less. It actually was in the 3s. So that recovered into the 4.4 as some arbitrageurs were coming in there. But nonetheless, you're still trading at 4.4% on the 1 month treasury, where the 3-month treasury is trading around 5%, and then 6-month trading around 5.2%. So you're trading around 80 bips or more, 60 to 80 bips below the Fed funds rate.
Huh.
So how could
this is a very interesting curve. I'm trying to understand how to read this chart. So we're looking at the full chart, right? So from 1 month on the far left all the way to 10-year on the far right, and even beyond
years,
that.
Actually, 30 years.
30-year. Okay, yeah. Got it.
10 year, so, 15, 20. Yep.
Got it. Yeah. So explain this. Why is this curve so inverted at the 1-3?
Right. So the main reason that's driving that is the concerns over the debt ceiling and the inability that there could be a scenario where the US government is not going to be able to pay its obligations coming 3 months or 6 months from now. So what you're seeing is a lot of money is actually weighted into the 1 month with that worry. So they prefer to invest over the 1 month that they know that's coming before the debt ceiling crisis. And literally are willing to get paid less for that. Where here it's the other inversion that we're used to. So the 10 over the 2, for example, where the 10 has this expectation of a recession, so it could be a little bit lower versus the 2, which is higher because the Fed hasn't really cut rates yet. So this is a really interesting type of inversion where, we've never seen this before. Even during prior debt ceiling crises, it always was assumed the can is going to get kicked down the road and there's always going to be an extension of the debt ceiling. But we know that the current political situation and how difficult it was for the Speaker of the House to get elected and what kind of concessions he had to make makes the whole situation of whether or not the debt ceiling is going to get resolved an actual big question mark right now.
So the market, what you're saying is the market seems to legitimately believe that there's a real likelihood of a technical default of the U.S. government on its debt.
Right. And that could be as early as June, given that we're seeing the X date of tax revenue come in, meaning that the X date is this assumption of taxes are enough for X period of time. And then that X date arrives, and then you have to borrow for the balance of the year because tax revenue is not enough for the budget. So that X date has come from October to potentially as early as June because tax revenues are down, which makes this debt ceiling fight really, really significant really soon. So to your point, what you're looking here as is the pricing of U.S. credit default swaps, basically an insurance policy that you can purchase to protect yourself from the default of the United States government. So clearly that shouldn't be, that's supposedly the safest borrower in the world. So when you're saying the market is genuinely concerned the United States may not be paying on its obligation, that is 100% true. You're seeing here, that's 2008, and this spike there. This is a 2011 United States credit downgrade, right? So we had a 20% equity meltdown when the U.S. credit was downgraded in 2011, and look at where we are now.
Wow. So this chart, the spike that we're going through right now makes 2008 and 2011 look tiny, look insignificant.
Right. It's almost 3x the size, which means that there's some real money buying the CDS with true concern that you could get a technical default, and then that CDS is going to pay out on the other side, which translates to what we're seeing in the yield curve inversion. This is literally, correlates very, very well to that 1/3 month being inverted.
Got it. So we can think about this as large institutions are rushing right now to insure themselves against this risk effectively.
Effectively, that's a good way to look at it.
Is this is this the most severe spike, or I guess the highest that this we've ever seen these CDS prices spike before, or has it gotten higher than this in the past?
For the insurance of a 1-year default risk for the U.S., as far back as I can see in my terminal.
Wow. Okay. So what does it mean? So what do we do?
Well, we shall see, right? But I think that it may have very significant consequences to anything from a Vanguard money market fund to the credit downgrade, like to the entire credit of the United States, where it could show a lot of political uncertainty. And the safest borrower in the world possibly not being as safe as some think. So again, just not saying that this will happen. Odds are still higher that they will find a way to kick the can down the road, but definitely something to watch for.
Yeah.
And that translates right into all this conversation we've been hearing about the dollar, right? Because treasury markets, paying interest, and the currency itself, they all go hand in hand.
Yeah.
So is the dollar still king?
I don't know. You tell me.
Recently, we've been hearing a lot of chatter about the dollar demise. I mean, that's really not new, right? Even post the financial crisis, QE, buy gold. Then after COVID, it's buy Bitcoin. But that idea of the dollar not being able to maintain reserve currency status is definitely been on some people's minds. And when you're looking here at the Google trends of dollar collapse, there's been a very big spike recently. And some of it is somewhat merited. A lot of it has to do with this idea of weaponizing the US dollar, which is something that really happened post the Russian invasion of the Ukraine, which, if you recall, the dollar has been fully weaponized, both by taking Russia off of the SWIFT international payments and banking system, really confiscating their central bank balances that were held in dollars and excluding them from commodity trading that's taking place in dollars. And even though these were merited by the West, right, for given what was going on, a lot of countries around the world are looking at this and thinking of it as, currency is supposed to be neutral, just like gold is. And when they're looking at it and saying, well, if I do the wrong thing in the eyes of the West, they can do this to me. They can cut me off of international payments. They can prevent me from trading in commodities. And that is a big concern for a lot of nations around the world, which is potentially causing a further or a faster shift away from the US dollar as a global reserve currency, post the weaponization of the US dollar. So to make this clear, there has been some shift away from the US dollar before the Russian invasion of the Ukraine, but this seems to have accelerated it.
Yeah. So we have people like Apology very publicly on Twitter calling for hyper Bitcoinization. You have Russia and China trying to fight people to get them on the ruble and the yuan, respectively. What does this mean for, the chart here is talking about US dollar as a reserve currency. Do you think that there's a chance of a change in, who holds the crown, or is it more just around moving from a unipolar to multipolar world?
Yeah, and this is really the point of this chart. So when you're looking at the share of dollar as the global reserve here in 2022, and this goes back quite a bit, you can see that the US dollar is still maintaining a relatively stable 60-ish% of global reserve. However, this is declining, right? So it's going down from, in the 70s, this was 80% plus, and then going into this area. The euro is still, just kind of the second right now. The yen and the yuan has still quite a bit to go in order to kind of catch up as a global reserve. But that's not to say that the dollar is not losing real share relatively quickly as we're seeing now. So there are definitely some alarming signs of what we're seeing, where in real terms, you can see this acceleration post the war in Ukraine versus a trend that was already somewhat moving lower. And that's really compared to some of the other currencies that are relatively unchanged.
Well, what confuses me about this chart is how can US dollar see a 19% decline, but we don't see 19% moving into other currencies? Does that mean yeah, go ahead.
Yeah, we have seen a big increase in the gold price recently, and central banks are buying record amounts of gold. So commodity base could be a big. So when you think of currency, commodities are currencies. So when more transactions take place in commodities or gold, that's definitely some sort of alternative as well to just a fiat currency.
Sure. Well, that's a very substantial change.
Right, in real terms, right? So if you go from 65% to 60%, that's roughly a 10-ish% drop, right? So it's not necessarily in percent; it's that type of term that we're talking about. What is very concerning?
Sure.
Right. What is very concerning right now, and this is something that I'm watching very carefully, is whether or not foreigners are going to buy this dip in the dollar index. So dollar index is down around 10% from the high, which for currency is pretty substantial, right? For example, the euro got last year to 96 cents per dollar. So it went below parity to 96 cents. Now it's trading back at 1.1. So that's a pretty big move. That's about a 14% or so, 14, 15%. And when you see the dollar index dropping, the foreign governments and sectors usually start buying U.S. treasuries because they're very appealing, both in terms of yield, because now the 10-year is almost at 4%, and in terms of the fact that the dollar index has dropped. So they're getting a relative value to their currencies. So you can really see that here, where total U.S. treasuries held by the foreign sector when they're high or low. So, when the dollar goes lower, they typically accumulate more treasuries. So right now, as the dollar has gone lower, right here, unlike prior times where the dollar is going lower and the treasury accumulation takes place, right? There has not been any treasury accumulation of the foreign buyers at all. So foreign buyers are so far, despite a 10% plus drop in the dollar index, have not bought U.S. treasuries so far.
Wow.
And that's
that's the first time ever?
First time I see it for a long time, yeah.
Wow. So the sentiment could really be changing on the international, on the global scale.
So this is we started this with kind of a micro of talking about the specific earnings and the 7 companies driving the stock market, etc. But it is important to kind of follow the super macro events that are taking place, is these have extreme consequences in how our financial markets and really our lives are going to play out. So again, I'm not saying the dollar reserve currency is going away necessarily, but this is something that I'm paying extra attention to.
Do you see this as part of the broader trend of deglobalization that we're seeing it just, across the board? Like, are countries more favoring their own domestic currencies and investments, or what's the replacement? Right, that's what
we're definitely seeing that. Yeah, but just keep in mind that a lot of emerging economies can't really do that because they need international trade. They need hard currency. So a country like Argentina, let's say, their domestic currency is not going to carry a lot of weight in international markets. So some currencies can move more into their domestic currencies the way China is doing, but some others like Turkey or Argentina would have a much more difficult time doing that, just because the way that the dollar system works. What I think is super interesting in this chart is that Chinese yuan actually overtook the US dollar as the most used currency in China's cross-border transaction for the first time ever. So the yuan was now 48% of trade. And just think about it. In 2010, when China made a goal of really moving away from the dollar, they decided to do that in one of their congressional meetings when I believe Xi was just taking place. When he was just coming in, it was zero, and now it just exceeded the amount of dollars in this trade. So again, it's incredible. So some changes are taking place, and I've heard a lot of discussion over, okay, so is the yuan going to replace the dollar? And I really don't think so.
Yeah, I mean, you have to respect the patience that China has with these types of shifts, right? Like, they can play on a 10-year, 20-year, or 100-year time horizon, because when you have a top-down singular approach, this chart is a good example of that. If, like, you saw one steady trend, you saw the increase going fairly well for about 5 years, and then you saw it got shaky decline, but it's right back on trend line for, from 2017 up until now. That's a lot more than, let's say, a 4-year presidential cycle here in the US.
Right. The kind of the benefit of the almost borderline corporate system that they have there. Right. But then at the same time, when you're looking at it on a global scale, and this is something that I want to remind you, that the dollar is still not going anywhere that fast. When you're looking at the total share of global reserve, the dollar is 55 to 60%. Share of international payments, and this is again excluding the Eurozone, which is an enormous economy. And that's, of course, because they use the euro. It's still almost 50%. But when you're looking at total share of trade finance, the loans are being made in dollars still to the tune of 80%. So the system is so ingrained and so self-reinforcing that it's very, very, very difficult to move away from that, which is, again, the end conclusion of what we're seeing is, yes, it's worrisome. Yes, we have to monitor this trend, but is the dollar going away tomorrow? Absolutely not.
But, fear plays, right? Fear plays in the headlines.
But it's still something to keep in mind, because these trends play out over decades. They don't play over months. They don't play out over years. And it is definitely on a downtrend. And I think usually these events, people are like, oh, is the dollar going to not be the global reserve currency? It's not like on Monday it is and on Tuesday it's not. It's a process that lasts for decades. And then before you realize it, the share of the dollar is really low. And it just happened. And it's a slow process. So it is something to keep in mind where when we talk about it and what kind of policy policymakers decide to do. Obviously, I'm sure they have the kind of like the status of the dollar as some of the things they think about.
I think, and tell me if I'm wrong here, but I think also with currencies, it's, reflexive loops are just as real as they are in equity markets, where if we're all talking about the decline of the dollar and reporting on it, and, it's in the media, it's in the zeitgeist, well, that becomes concerning if you're a sovereign nation. You're thinking about, oh, well, where do we hold our reserves, and what do we want to do commerce in? And it kind of becomes a self-fulfilling prophecy.
It can be, and it can last for a while, but there's still fundamental economic reality. And a lot of times what happens when the pricing of markets get too far away from the fundamentals, there's a recognition event, and then there's a quick return to fundamentals. So it's kind of like reflexive loops can last, and the market can go in the quote wrong direction for a while, driven by psychology. And that's really what fuels bubbles too, by the way. So a bubble is fueled by the reflexive loop where people are just buying because they get that FOMO and they just want to chase and get rich quick. And, oh my God, it's going to be 100x in a year and I'm missing out and all this stuff. But then it's so overblown from the real value and productivity that it created. And then there's this moment of recognition and then boom. So bubbles face of it, this is the classic kind of bubble psychology. And we've seen it in so many things, from .com stocks to the railroads to, tulip mania. I'm not going to say crypto.
Would you say in the case of the de-dollarization trend, would you say that the reversion to the mean will be a return to the dominance of the dollar? Like, meaning, do you feel that economic reality still favors the dollar, or do you feel that we've actually still got a lot more share to lose before?
I feel the economic reality is probably slowly negative dollar, but over a long period of time. So when you're trying to price that out, what does that mean for the US dollar? So there's a famous theory called the dollar smile, which I still think works pretty well, which is when the kind of like when the economy does very poorly all around the world, because we are still in a globalized world nonetheless, money actually flows to the US as a safe haven into US treasuries, and that causes a spike in the dollar. Like we've seen that in 08, 09, and we've seen it as recently as last year, and we've seen it as recently as 2020 during COVID. Even though the US was going on money printing, then there was an initial spike and a move up in the dollar. And when the US does really, really well, and the US economy is booming, everybody wants US assets, and the dollar does really well as well. So it's actually the in-between, when the US is kind of meddling around and it's not the global top performer, then the dollar weakens, which is interesting. So far, I haven't seen any evidence that the dollar smile theory is not working anymore. We'll see if we get into a more significant bear market and there's a real scare in equities and around the world. Is the dollar still going to act as a safe haven when that event happens? That's the billion-dollar question. And, if history is to judge,
we'll see soon.
We'll see, right? The next 20% equity drop, we'll see how the dollar performs.
Got it. Well, we know what to look for now.
So another big macro topic that is on a lot of people's minds, and I wanted to cover very quickly, is the housing market, right? I keep getting asked the question, is now a good time to buy a home, continuously, where, prices are down maybe 10%. And, what's interesting is that we are a very low, kind of terrible place in the affordability index. Granted, the early 1980s were worse, and that's because interest rates were absolutely absurd. When you think about the early 1980s, when the Fed fund rate was in the mid-teens, right? Mortgages were probably in the teens as well, probably as high as 18% or something. So even though the prices of homes was relatively low, the mortgage was just so cumbersome that affordability was terrible. I think this is somewhat of the old norm for affordability. And then 08, 09 happens and the housing markets just crash and rates go to zero. That was a pretty abnormal period of time because we had massive decline in home prices, but then rates were also zero. So if you were credit worthy, buying between, let's say, 2010 and 2013 was the most affordable time in recent history. And then right before COVID, things were still okay because rates were very low. And then post-COVID, we all know that homes became very, very expensive. And now rates have gone very, very much higher as well. So affordability is very poor. And it's gone up a little bit. So this decline recently is this little blip you're seeing here.
Yeah.
But we are basically at '06 levels of affordability when measured by home prices over interest rates. If we go back to the kind of old normal world, it may go to this 140 area in the index. Are we going to go back to what we've seen post the global financial crisis? That depends on whether the Fed really cuts rates back to zero or not. If they don't, we may be seeing the kind of like pre-GFC type of affordability. But either way, it looks like there's more room to go, either rates going lower or home prices correcting lower. One of the two should happen, maybe a combination.
Okay, so this is another one to keep your eye on.
Yeah, and when you can really look at this in 2023 versus other years, this is the idea of what your mortgage payment is for that median home. So if you're buying a home for the median asking price across the country, that's what you were paying in 2020. So you're paying $1,500. In 2021, you're paying a little bit more than that. 2022, it was getting higher and higher as this is going. In 2023, as of April, at the average rate, at the median price, you're paying $2,555 a month for your mortgage payment, when again, just 2 years ago, it was $1,500.
Wow.
So that's just to quantify what that unaffordability is.
So this is another factor contributing to the squeeze on consumer wallets.
And the squeeze is very, very real on top of inflation. So again, we continue to track this. And buyers are sitting on their hands. Pending home sales remain very weak, even though there was a little bit of a bounce after just a very long period of contraction. Still down 23% over the last year. This is the 22nd consecutive year-over-year decline when measured by month. And it's very important because it's a leading indicator of housing activity. And housing activity is one of the most powerful leading indicators for the economy as a whole, because housing drives so much of the economy. And again, this is that housing bubble. We got to 2009, 2010 levels of housing activity and pending home sales. That's the COVID bump when everybody was moving to the suburbs. And look at where we are now. So again, something we're monitoring very quickly, as this has very, very large implications for the economy as a whole, and this remains in the negative for now.
So housing bubble 2.0, is that what it's looking like?
Yeah, but we haven't seen the price declines yet. So we need the jobs market. So in order for that to happen, the jobs market will likely deteriorate. So the future demand side of it. So the leading indicator of the leading indicator is lumber prices, because lumber comes first when you're trying to build new homes. And keep in mind, lumber futures are down 80% from their peak of May of 2021. And they're completely down all the way to those 2019 levels. You can see that COVID spike actually looks a lot like the spike in the saving rate with the stimulus almost. It's interesting. But demand is substantially down, as evident by lumber futures.
So this chart goes back quite a long time. And it looks like it had been kind of range bound and then exploded during COVID and has now collapsed back to, do you think, it's really just back to the previous levels. Do you think that it's going to get even lower? Where are you thinking this takes us?
Yeah, it's hard to say, but it really is a barometer of just demand from home builders. So right now, materials are much more affordable than they were before. You all heard about like the COVID shortages, and it's really tough to get new homes, and prices were going up. So this is actually a net positive for home builders, but it's a net negative for demand. So who's basically buying homes? Housing activity is down, so you need more activity in the market in order to really get lumber to move higher, because that's primarily the demand for lumber. And at the end of the day, we just have to remember that all of this is just driven by money. And what do I mean by that? It's the money supply, not money itself. So is there more money in the economy? Is there less money in the economy? If you put a gun to my head and tell me what is the whole general macroeconomic theory in a sentence, do you have more money or do you have less money? And right now, we have less money. M2 money supply is down another $257 billion over the last month. And that is 4% year over year deceleration. It's actually the largest deceleration of money supply that I can see in history. There's some unclear data going back to the 1920s. 1920s, 29, 30 was probably similar to this. But nonetheless, we're used to money supply continuously going up. Here you see the kind of M2 money supply chart growth. We had an explosion in money growth after COVID, almost 30 cents for every dollar. But now rates have gone higher and money supply is going lower. And you can see here this blip, lower money supply. Just to give you a context, here in 0809, money supply contracted as well. And it didn't get into the negatives. Then we got into kind of 2019. This was somewhat misleading because it was offset by tax cuts that actually increased liquidity into the economy in 2017-18. But this is somewhat different as money growth is completely negative. And this is something we're watching for as well as the Fed balance sheet.
What we need is your favorite image of Jay Powell and the money gun. We need now Jay Powell at the money shredder, right? Because he's really having a good time at the money shredder at the moment.
It's the printer in reverse. The money goes back.
Right.
So that's really it for today. Try to keep it a little bit shorter, just to give you the main context, all the topics that are happening right now. And we'll cover it again on the next call. I'm sure there's going to be a lot of developments. There's a Fed meeting actually in 2 days, which they're expecting to raise rates again, probably to about 5.25%. And the market is expecting that to be possibly the last rate cut or hike, possibly the last rate hike. And there's a lot of expectations for rate cuts today or this year.
So question for you. Over under between this and our next market conversation, could be in 2 weeks, could be in 4 weeks. Over under another bank failure between now and our next call.
Probably not another bank failure in the next call. I think that's probably Q3.
Okay. All right. Well, there we go. So that's all we got for you today. Appreciate the time, Itay. Thanks for breaking it down. And hope everybody has a great rest of their day.